Dear viewers, last few weeks have been a bit volatile for stock investors for multiple reasons. Earnings season and misses from the expectations, foreign money outflows amid China's stimulus, and tensions between Iran and Israel have made markets a bit nervous. The impact of most of these macro events will even out, appearing as noise for long-term investors. However, there is one event that has once again brought to the forefront the question of India's energy security. In the recent years, themes like electrification and green energy have taken over any discussion on energy. Yet, the truth is that we are still dependent on imports for 85% of energy requirements. And any supply disruption or sharp rise in the crude oil price is negative for India's growth story. Bottom line, we need to be self sufficient for our energy needs. To be fair, policies have been focusing on this. A case in point is the shift from NEL or New Exploration and Licensing Policy to OALP or Open Acreage Licensing Policy in 2016 and 17 for oil and natural gas exploration. Under NEL, it was the government that used to put an oil and gas block on tender. However, under OALP, the players can select the exploration block on their own. This is likely to bring more area under exploration and production. To encourage this, geoscientific data is made accessible to all players under National Data Repository. If the block selected by a player is suitable for award, competitive bids are invited under twice-a-year bidding system. Unlike NELP, where the government's income was from profit sharing, OALP is marked by revenue sharing. In the previous profit sharing system, the government had to carefully examine the cost of information provided by various private players that led to delays and disagreements. The new system also allows for single or uniform licensing system to cover all hydrocarbons. The ninth round of OLP was concluded in September. The next round is expected early next year. In the 10th round, areas or regions that were termed no-go earlier will be offered up for opening, and this will lead to more opportunities for exploration and production companies. As some of you know, the gestation period in oil and gas exploration can be long, and the final output or yield is not certain despite initial investments. As such, instead of dwelling on oil and gas exploration and production companies, I am focused on the companies in the ecosystem. And that brings me to a specific small cap player, Deep Industries. For over 3 decades, Deep Industries has been providing various oil and gas support services. These include gas compression to ensure flow of natural gas through the pipeline and dehydration of gas. Dehydration is a regulatory requirement for gas production and transportation to avoid blast and other hazards. It also offers workover and drilling rig services and integrated project management services. Its offerings find applications right from exploration and production to midstream services. Across most of these offerings, Deep Industries is a pioneer, the only player and market leader. Its latest industry segment is EPC or engineering, procurement and construction of entire gas processing facilities on charter hire basis. With this, Deep covers over 70% of post-exploration in the oil and gas service value chain. Its clients include almost all leading oil and gas players like ONGC, Ken India, Oil, GAIL, Vedanta, Reliance, SR, GSPL and Ceylon Exploration to name some. Apart from oil and gas players, its target industries under offshore service markets include communication, transmission and transportation, undersea power and data cables. The latest quarter ended September has been the highest ever for the company in terms of revenue and net profit. The return ratios have been on a rising trajectory. The return on equity and capital employed excluding intangibles has been at 14.4% and 15.6% in the half year so far. The debt to equity is at 0.16 times. The company has been awarded production enhancement contract recently, leading to 119% year-on-year order book growth. Its order book at over Rs 26 billion, it's 5 times of its trailing 12-month revenue. The management has guided for 35% growth over next 2 years. The stock is trading at a 12 months PE or price to earnings multiple of 22 times and PEG or price earnings growth of 0.4 times. Now do note that this is not a recommendation. Any investment is subject to risk and needs due diligence, and Deep is no exception. That said, as India gets serious about its energy security, this is a must-have stock for your watch list. Hope you found this information useful. Let me know through your likes and comments. I'll be sharing more such opportunities in the small cap space. To avoid missing, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.